Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. We have a big week of earnings coming up and markets are largely the same as where they were a week ago. So let's review where we currently sit. A lot of questions regarding, whether markets are overbought and we're due for a correction. So hopefully we'll try to answer some of those questions during our session this morning. Before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off with our major market update just to see where the major indices currently sit and provide some insights into where we see potential opportunities within the major indices. Then we'll take a look at sector rotation, what data is telling us from sector rotation that speaks to the health of the market rally and which sectors you want to pay attention to and look for opportunities and which sectors you want to stay away from. Then we'll take a look at fixed income markets, something very, very important, some trends that are emerging here, fixed income markets that we need to pay attention to, especially as some of the concerns about inflation expectations continue to dominate the headlines and dominate corporate earnings. Then we'll take a look at economic data, which largely solidifies and shows us those inflationary expectations in some solid numbers before we share with you some of our ideas here for today's market. But the primary question that we've been receiving here over the past couple of days has really been around the fact that our market's due for a short-term correction. And there are a lot of concerns about this because we've seen markets trade at near all-time highs for a long period of time. They've been overbought. They've been signs of exhaustion here. And the question is, are we due for a short-term correction? So I want to share with you my technical charts, my economic research, the ways that I'm currently looking at the markets to hopefully help you answer some of those questions. But before we take a look at any charts, we have a big earnings week coming up. You can find the earnings calendar on the OptionsPlay platform or on the OptionsPlay hub. This allows you to see every single stock that's reporting on this particular date. Ones that are with the asterisk are the ones that are reporting in the mornings. The ones that without the asterisk are the ones reporting on the evenings. And they're ranked by liquidity. The ones are in green with the ones next to them are all very liquid. The ones with twos next to them are not very liquid, or somewhat liquid, and the ones with threes are not very liquid, so that you can quickly see who's reporting. And this week we have almost 50% of the NASDAQ 100 reporting with Alphabet, Microsoft, Apple, Amazon all reporting this particular, and Facebook reporting this particular week. So we have almost 25% of the S&P 500 reporting this week alone, 50% of the NASDAQ 100 reporting this week alone. Last night we had Tesla reporting, underwhelmed investors a little bit. The stock's down about 2-3% post-market yesterday and pre-market this morning. And I think that that's largely what you're going to see from most of the major tech names, where expectations are fairly strong, meaning we expect most of these names to actually outperform and potentially beat earnings expectations. But as far as stock performance, we're not expecting big moves here to the upside. We have seen some moves here to the upside. UPS reporting earlier this morning, seeing about 8-9% move here to the upside. We've seen some of the tech names like IBM do fairly well. But if you look at things like Netflix, you look at Intel, you look at some of these big names that have reported but underwhelmed have also underperformed here. So we've seen a bit more dispersion this particular quarter than last quarter, which was actually the least dispersion we've seen, meaning stocks that outperformed did not gain in performance, and stocks that missed earnings did not underperform by very much either. This particular earnings season, we're seeing a little bit more movement from stocks. However, we have also seen a lot of stocks that have beat expectations, that have had very strong earnings and revenues, actually shares underperform. So that is still the major theme here for this particular earnings season. And especially when you have 50% of the NASDAQ 100 reporting in a single week. This has not happened very often, but when they do, performance that particular week is not very strong. So, when we look at the major markets, we want to keep that in mind here. So S&P 500 near all-time highs. You have a basic double top here. We failed to break out above that double top. So that certainly puts a small correction here to the downside in view here. But, I think just a pullback to the 21-day moving average would be sufficient, because if we look at the overall health of the market, it is fairly strong here. And markets are not overbought right now in terms of the short run. So a small correction to the 410, low 400s is certainly potentially constructive here for the S&P 500 to continue moving higher here. When we look at the large cap S&P 500, you look at the NASDAQ 100, they're largely in the exact same place. You have a bit of a double top forming here from the previous high about a week ago on the NASDAQ 100 or QQQ. You're looking at about the 340, 342 level here to the upside. Again, potentially a small correction here down into the 323, 330 level here. 330 level here to the downside, which is corresponding roughly with the 21-day moving average. Those are, when we talk about correction, that doesn't even count as a correction in my opinion. But that would allow the markets to really continuing to move higher from moving on forward. But if we look at the mega cap names, the S&P and the NASDAQ, with its double top, certainly the upside here is a little more limited than if you look at the smaller cap names, the IWM, Russell 2000. After moving sideways here for the past roughly 2 months, after what was one of the strongest rallies we've seen here in small caps, it is starting to break out here to the upside again. We still have one major resistance level around 235 to contend with, but it is starting to break out here, unlike the S&P and the NASDAQ that are still mostly range bound and neutral here. We're starting to see a little bit of strength here from small caps. And this is constructive here, especially when you look at the RSP, the equal weight S&P 500 index outperforming the mega cap S&P 500 index, telling me that the smaller names in the S&P 500 are actually doing better than the big cap names that are making the dominant percentage of the S&P 500. Now that in itself is relatively healthy for the market. You want to see broad-based performance for the markets continue moving higher. When you see the opposite, those are the signs of a market top. Those are the signs of a major correction, of a correction coming. So when you see the broad-based S&P 500 stocks outperforming the top few names, that is constructive. But however, when we look at the equity markets, we certainly see the smaller cap names, the lower cap on the spectrum are the ones that perhaps may outperform here going forward. And especially when we look at the value versus growth sector as well. This is something that we continue to talk about for those of you that have been following me for quite some time. Value has underperformed growth for multiple years, but has formed this bottoming formation since the start of the pandemic. This is a weekly chart here on the left. We've now broken out here to the upside, which confirms that this bottoming formation is complete. We've now come all the way back to retest this level as support. This is the zoomed in version of this, the daily chart on the left-hand side. You have this bottoming formation that had this resistance level, broke out above it, and now we're all the way back to retest this level. So far, this support level has held. This certainly puts the risk to reward ratio in favor of being more on the value spectrum versus the growth spectrum. So as you look for opportunities here in this market, you want to segment where in the markets do you see the best opportunities going forward. So for me, going smaller cap, going towards value still remains the better bet here going forward with equities, meaning the mega cap tech names are less likely going to perform that outperformance here from equities, which is where we've seen the performance since April of last year. But now we're starting to see value, we're starting to see small caps perhaps provide more sustainable growth here to the upside. So when you look for opportunities here in the equity markets, you want to make sure that you're positioned correctly. And the charts certainly favor smaller cap value names here at the moment. When we look at the fixed income markets, after what has been a very strong rally in yields from that 100 basis points all the way up to 185, we have spent the last month now consolidating, but so far it has held this 155 basis point level, which had provided some support here prior to the pandemic and is now providing some support here. It also corresponds with the 31.8% fib retracement level. So this, in my opinion, provides a little bit of stability and equilibrium here for the 10-year yields. And this really allows the 10-year yields potentially find a little bit of equilibrium and see if it can potentially break out here to the upside. And when we look at inflationary expectations or concerns, that is potentially the catalyst that could drive the 10-year yields continuing to break out above that 175 basis point level onto that 195, 220 basis point level here to the upside. When we look at the long-term chart, those are potentially our longer-term targets here to the upside. And when we look at TLT, which is inverse to yields, this is really where we see some interesting charts here. TLT, very strong downtrend here, as you can see on the weekly chart here. And if you want to draw this on the daily chart, as you can see, there was a pretty clear channel that we saw TLT was trading in to the downside. It was a very, I would say, orderly downtrend, if you will, before it started to break down here in late February. After breaking down here, it's now come back and I would say retest this prior bullish support level here. Now it's testing it as resistance. And this is a pivotal, I would say, moment for us to pay attention to here for TLT, because will this continue to move lower here? That is the question. And if you draw your charts a little differently here, what you start to see is what looks like a continuation pattern off of this strong downtrend. We have this strong downtrend that started to put in place back here in February. We've had now a continuation pattern or a consolidation pattern, whether you want to call it a flag or a pendant. It hasn't broken this flag or pendant yet, but this is one that we're very close to. So I would pay attention to, because if you do get a breakdown below the support level, you start to project down into the high 120s, the low 130s, high 120s here, which certainly puts you in line with this last fib level here to the downside. You still have some support here around this 135 level here. I think it's important for us to pay attention to this 135 support. But if we break below that, I think we're headed back towards 124, 125 here to the downside. And you know, when you think about inflationary expectations, that lines up with this concern that TLT, the Treasury bonds that are not hedged against inflation, will continue to sell off as real inflation expectations continue to rise. And then when we look at, you know, if we look across the risk spectrum, so first we look at Treasury bonds, next let's look at investment grade bonds. Investment grade bonds also not particularly strong, starting to be in a downtrend after a multi-year uptrend here, and still so far continuing to be below these major support levels around 134, which now act as resistance. After this big sell-off here, we've had a bit of a consolidation, a bit of a bounce here, but it is starting to lose a little bit of momentum here to the upside. As you can see, RSI is now flat and moving sideways and no longer continuing to move higher here. You have some support, some resistance here around 132 or so that is so far acting as resistance. So LQD, investment grade, also not performing very well here. And the only one still performing okay is HYG, higher yield. So we have to go further out into the risk spectrum to see yields continue to hold up. But we're also starting to see this momentum roll over here a little, as this is starting to make lower highs and lower lows. So some of the concerns that we're starting to see here in the further risk spectrum with high yield, you know, starting to look a little bit like investment grade and starting to look a little bit like treasuries. So when high yield is no longer outperforming here, that's some of the concerns that we start to see here with the risk, with the fixed income markets. And that also speaks to some of the inflationary concerns that we're going to talk about here when we look at those economic numbers. Now, sector rotation, we talked about this last week. For the first 2 weeks of April, we talked about the fact that there was a lack of sector rotation, and that's unhealthy for a market rally. And we were concerned that that was going to continue, because if that continued, those were the signs that we typically look for near a market top before a market correction here. But last week, we started to see rotation continue, or we started to rotation start. And now this week, we're seeing rotation to continue. So that concern that we had at the beginning of April largely has gone away. And we continue to see a healthy amount of sector rotation. We have healthcare now in the leading category, both utilities and real estate in the leading category here. Financials starting to get into the improving category, energy starting to become improving here. So you have quite a few sectors moving towards either improving or leading. And then you have consumer discretionary and technology, the two that were leading for quite some time. As you can see, technology led for quite a bit of time. So did discretionary lead for quite a bit of time here, both moving into the weakening category here. So as you see, the strongest sectors move into weakening, the weaker sectors move back into leading. Those are signs of a healthy market. And then you have industrials, you have consumer staples and communications continuing to be in the lagging category here. The one thing that's interesting to see is that industrials and materials have started to bifurcate a little bit. We're starting to see materials outperform industrials. This is an interesting trend that's emerged here. I don't necessarily know that industrials will continue to lag behind. It's likely going to start improving here alongside materials, but also financials. Especially as we look at inflationary expectations and perhaps interest rates stabilizing and perhaps rising from here, financials also coming back to life here. But I will say what's interesting here is that the U.S., expectations for U.S. interest rates remain fairly low here in the short run. But, we're looking at, if you look overseas, you look even in Canada, we're starting to see interest rates rise faster than they are here in the US. So for those of you that are Canadians or trade Canadian banks, we're starting to see some of those Canadian banks outperform US banks. So looking at the economic numbers here, this is really where, we've been talking about manufacturing and services becoming extremely strong. Manufacturing has been strong since pretty much middle of last year. And we really need to see the services side of the market outperform here to give us the confidence that the economic recovery is taking shape. And we've started to see that emerge over the past few months, January, February, and March. Services hiring, services PMI continue to do well. That tells us that the vaccines are working, that reopening is happening, bars, restaurants, travel and hospitality, employment is starting to gain, and that's largely what we have seen. But manufacturing remains the strong point here in our economic recovery. We've seen a lot of interest in bringing manufacturing back onshore because of the supply chain disruptions that have caused major concerns for manufacturers, as we've seen raw material prices continuing to rise here. And we've seen this huge spike here in raw material pricing that we haven't seen this type of spike here before. That's going to cause some concerns for consumer goods. That's likely going to be passed on to consumer goods. That's some of the inflationary concerns that we have here. But also wage and benefits. We've seen labor shortages from the result of people needing to work from home. We've seen a major shortage in terms of women re-entering the workforce because they're likely staying at home because their kids are being homeschooled or still have to, can't go back to school. So they have to stay at home and they're not able to rejoin the workforce. We've seen still a large percentage of the US population on unemployment benefits not getting back into the workforce. So there are major short-term constraints that we still have on the labor pool, and this is causing some major disruptions in terms of inflation, meaning the amount that employers need to pay in order to attract an employee, the wages and benefits that they have to pay in order to keep them on board before they leave for another job. And one of the things that we've never seen here before is mentions of inflation on S&P 500 earnings calls. Look at this spike here. This is going back 2 decades. 12% of S&P 500 earnings calls now are talking about inflationary concerns versus, as you can see, historically, the highest we've ever seen was about 4 or 5% here. So this is one of the major concerns that we start to see here, with companies that are very sensitive to wage inflation. So think companies like Amazon, Walmart. These are the types of companies that will struggle, McDonald's potentially, or have to make major shifts in automation to reduce their dependency on their workforce in order to gain productivity. This is going to have some major ramifications here for the markets over the next couple of years, and even in the short run, in terms of higher consumer prices, but also industrial names, automation names. Those are ones that are going to do fairly well. And there are industrial names that are very sensitive to inflation that do well, like Caterpillar and Deere. When metals rise in prices due to inflation, when food prices rise due to inflation, for those of you that joined us here last Friday on our members only session, we talked about the future of food and agriculture. We identified quite a few names that are beneficiaries of this food inflationary trend that we're starting to see. These are the things that you want to think about as you invest here over the next few months and the next few years, because those are the things that are going to drive the bifurcation that we have continued to see here since the start of the pandemic. So one of the names that that points out to me in this trend is a stock like Newmont Mining. Gold miners have done well, especially as inflationary concerns start to rise here. As you can see, this is a stock that has continued to trend lower here against this downtrend, but recently over the past week has started to break out higher here. And we've had this breakout and a bit of a pullback here. That pullback, in my opinion, is that opportunity to look for upside here in a name like Newmont Mining that has started to outperform not only the sector, but also the gold miners. So looking at this particular stock, set up from a chart perspective, looking fairly strong. And also in that materials sector that we are starting to see outperformance here versus industrials. When we look at healthcare, CVS, healthcare is also one of the sectors that are starting to outperform here. CVS has been on a multi-year decline, multi-year underperformance, but over the past couple of years have started to put in this bottoming formation, this triple bottom here around this $52, $55 level, and has now started to break out above this downtrend here. As you can see, it's been basing for quite some time, but right now I do think that it's worth continuing to pay attention to, because as it continues to trade against this $76, $77 level here to the upside, it continues to put in higher lows, multiple months after month, week after week, higher lows. So I do think that you have a fairly high potential of a breakout here for CVS, especially as you look for healthcare names to start to outperform and starting to outperform the market. CVS, one of the major names in this particular category that can outperform. We've seen Walgreens already break out to all-time highs, relative highs. CVS here, as you can see, and this level, 76, 77, goes back a long time and really kind of points to this bottoming formation starting to complete and the potential breakout here above that bottoming formation. For those of you that, you might call it a cup and handle, you might call it a triple bottom, however you want to call it, this is a potentially interesting, I would say, pivotal moment here for CVS. And then on the earnings plays this week, for those of you that have followed me for quite some time, you know that I've been bullish on Snapchat here over the past couple of quarters. Pinterest have been a very close second behind Snapchat on each one of these moves here to the upside. We did see Snapchat report last week, not particularly strong or not as strong as investors wanted, even though the numbers were fairly strong and Snapchat started to trade lower here. But this is one where I still think Pinterest has a little bit more upside left to go, especially if you look at some of the download data here for Pinterest versus the other social media platforms. Pinterest is one of the few that have not seen a decline in downloads. So I actually think Pinterest still has a little bit of upside left here for earnings here this week. One of the few major tech names that I still see outperformance here this particular earnings quarter for those of you looking for some tech names. And then Boeing. This is really one that we continue to see losing relative strength going into earnings. This is one that I would generally stay away from when you look at the price action going into earnings, losing that relative strength. And then you look at the fundamentals of this particular company, continuing to look worse, even though the global aerospace sector is continuing to recover. We've seen a sharp decline here in Asia Pacific as well, the recovery in airlines because of India actually right now, and we actually expect that could get a little bit worse. So this is another kind of, I would say, a speed bump, if you will, on the road to recovery for the aerospace market, and Boeing, not recovering as well as that airline industry, and the continuing concerns that we still see with the 737 MAX and the repairs that they still need to do on quite a few of the new deliveries, the 777 delays out to 2023 and potentially even further. These are some of the concerns that we continue to see here for Boeing. So when you look at the fundamentals, you look at the technicals and the fact that it's continuing to lose relative strength here, Boeing failing to break out above this 240 level and holding on to those levels as support is concerning, and now it's starting to retest this level as resistance. So it's more likely, in my opinion, to potentially underperform here going into earnings than outperform. So that's how I'm currently looking at the broader markets, and I hope that this was helpful in giving you a better understanding as to, as you look at the equity markets, how you want to look at mega cap, small cap, how do you want to look at value versus growth, how do you want to look at the sectors, which sectors you want to pay attention to that are improving, which sectors are lagging behind that you want to try to stay away from, and as you go into earnings seasons, the different ways that you can look at the upcoming earnings season. So with that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here this Thursday on our next session on how to trade index options, or introduction to index options, on this Thursday's options education webinar. Thank you so much and have a great trading day.